one of the biggest mistakes that small business owners do is to actually mix their personal finances with the business finance. And I totally understand it, because a lot of times, look, you rarely have any money, you really can't pay yourself, and you're just struggling. The problem is this, there's really two. One of them is the fact that, well, when the IRS decides to audit you, they're going to want to see your books. And you're not going to be able to actually show them the company books versus your books. You're going to end up having to show them everything, all of what you have. So all of a sudden now you have an auditor that's basically going to decide one way or another, is this business or is this personal? And chances are they're going to push a lot of that you're going to say is actually business into your personal side. The second part of it is actually the fact that you have this protection because you have an LLC, right? So you have an LLC, it protects you, it's a limited liability company. Your liability is limited if you operate properly. But if you don't, it's not. So a limited liability company is a separate entity from you. It's like your big brother or your little brother. I just like to say little brother because then you can tell them what to do, right? So this entity is like your little brother, you tell them what to do. But if you're mixing your personal and your finance, you're mixing the two entities together. In fact, you're not treating the entity as a separate entity. Here's what happens. When it comes to court and you're trying to protect your limited liability, the judge's going to look at it and say, you know what? You have the paperwork that says you're a limited liability company, but you're not behaving like that. So therefore, no, you don't have a limited liability company. You have it on paper, you're not acting like it, so no, you don't get the limited liability protection that you were supposed to get having that company. So when it comes to payroll taxes, there's really two issues when you're a small business owner. So when you become, for example, a Schedule C, which means that you're a sole proprietor, the issue is this. You now have a tax that you didn't have before when you were an employee. When you were an employee, you paid withholding tax. So you had Social Security and Medicare deducted from your paycheck, right? But now you're the employer because you're also the business owner. So guess what? You actually get to pay the other half of that Social Security and Medicare. So the amount, when you try to figure out how much tax you owe, for example, if you're just a sole proprietor, is that now you actually take a look at your Medicare and Social Security and double it, because now you actually owe the employer side as well as the employee side. Well, I want to talk a little bit about the issue of classifying employees versus contractors and how it can come back and burn you. And in our current state right now, it's come back and burnt a lot of people. You know, we have this PPP program, right? Paycheck Protection Program. Guess what that's for? Employees, paycheck protection program. Well, if you had all your people at 1099, they don't count. You can't help them, right? So if they're self-employed, guess what? What the government said is they can get their own PPP program. In other words, they can apply for it themselves. So really, you kind of got yourself in a difficult situation. Now, that if you didn't do it for nefarious reasons, if you didn't do it improperly, that's okay. It's just the way it is. But there's another reason also why it's really important to classify your workers, whether they are self-employed, in other words, they're independent contractors, or they're in fact your employees. Now, the IRS used to have this 20 some odd questions that you had to answer, and that one would determine whether you are actually an employee or you are a contractor. Well, now they've reduced it to about 3, and it's not about so much questions as it is a concept. But really what it comes down to is this person that you're contracting with really a contractor? So a contractor is somebody who owns their own business, takes their own risk, and if they do a poor job, they actually lose money. An employee, on the other hand, is someone that you're actually taking full risk for, right? So, for example, if an employee breaks a camera, you're not going to charge them for the camera. You can't. You legally can't charge them for the camera, right? But if a contractor breaks something, yeah, you can actually sue them for it, right? So that's the big difference between the protection that an employee gets versus an independent contractor gets. So one of the big dangers when it comes to having your own business is you get really excited about everything you can deduct, right? And that's what I hear from small business. Oh, can I deduct this? Can I deduct that? And yes, you can if it's for a business purpose. But there are also a bunch of expenses that people like to deduct that may or may not be for business purposes, or they may not have the proper amount of documentation. One of them is mileage. It's probably the most common one. You know, people say, well, I think I drove 20,000 miles, right? So they'll put 20,000 miles, times the mileage rate to deduct it. There's a problem though. See, the IRS actually, they look for somebody who wrote 20,000 miles. They'll look for that 000 at the end of the numbers. If they see rounded numbers, they'll be giving you a call and they'll say, hey, can I get that mileage log from you guys? And you might not have that mileage log. So one of the other ones that is a very dangerous deduction to take, and it used to be a lot more dangerous than it is today because now they actually have a safe harbor way to take it, and that is the home office deduction. So the home office deduction, the safe harbor method, is $5 a square foot. Nice and simple. Now there's a more sophisticated method, which is the expense method, which takes into consideration, how your expenses, you can actually take your mortgage interest, you can take property tax, and you take a percentage of that based on the percentage or the square footage that you're actually using for the home. So what the IRS basically created was this safe harbor, meaning, you know what, if you ask for $5 a square foot, we won't bug you. But if and the maximum is 300 square feet that you can actually deduct. But now if you're talking about taking 1,000 square foot, right, because maybe you are using it, and that's okay. But if you are using that 1,000 square foot, make sure that your documentation is solid. Because one of the things that the IRS will look at is, in fact, that home office deduction. It is one of the most common reasons to get an audit. Entertainment now is no longer deductible. Ever since the tax changes in 2017, well, the law passed in 2017, but it really affected 2018. Since that law passed, entertainment is no longer deductible. That means all of it is no longer deductible. That means that if you take a client to a show, it's not deductible, right? However, the meal is still deductible. So if you have a meal with a client, that's not entertainment. As long as you're talking about business, that is still in fact a business deduction. So what can happen when you do your own tax return? How badly can things get? Well, how about $61,000 badly? And that's what happened to a person who came into our office and they had a letter from the IRS. They owed $61,000. Well, what happened was I took a look at the tax return. They missed one line item. One line item was wrong. It was a deduction that they actually could take. It was an exemption that they could take. But they did it themselves and they missed it. Now, the letter from the IRS specifically gave them 12 days to respond. And if they didn't respond within those 12 days, those $61,000 were due and they couldn't get into tax court. It was a final. Once I got a chance to look at the return, I realized where the problem was. And it was a one line item problem. Once I fixed that one line item, they went from $61,000 tax due to $0 tax due. And we got it in on time, and we never heard from the IRS again. We're done. It's interesting right now because, in this current situation that we're in a pandemic, right? And we have all these things called PPP, Paycheck Protection Program. We have EIDL, these loans. Record keeping now has become an absolute necessity and a dire one. And I'll tell you why. In the past, the IRS has kind of gotten a little bit lax when it comes to record keeping. Meaning, for example, let's say I have a credit card, right? And I use that to buy gas. Well, the credit card statement's going to say, you bought gas, and the IRS is going to say, yeah, you bought gas. It's pretty obvious. But wait a minute. Now you have something called the EIDL loan. Let's say it's you got one of the $150,000 loans from SBA, right? Well, see, SBA is not IRS. The SBA has its own set of rules. Now, SBA says this. They want a receipt for every single expense that you're going to pay with that loan. And they have the full right to ask for that. So all of a sudden, we're going from a little bit of a lax situation to a much more, I would call, old-time situation, which is we wanted receipts for everything. So keeping track of your receipts now, especially in this time that we're in, is extremely important. How long do you keep your records? For purpose of the IRS, they want them for at least 7 years. Now, in our case, as enrolled agents, we're actually required not only to keep a copy of your tax return, but to keep a copy of all the records that you provided us in order to do your tax returns for 7 years. So I would stick with those 7 years. Which legal entity should you become? Well, it's really a question as to where are you in your business. In other words, you don't have to be the exact same legal entity all the way through your business life. You're going to change, and some of that change is going to come based on your income levels. So jumping right into, for example, becoming an S corporation right away may not be the wisest financial decision. Because whether you're an S corporation or whether you're an LLC, you're still going to get the same liability protection. The difference is that as an S corporation, you've now requested the IRS to allow you to be taxed slightly differently. But with that also comes an expense. You now have a separate tax return that is not cheap. And you also have to process payroll, which you didn't have to do when you were just an LLC. But the key thing, though, is to really talk to somebody who actually prepares taxes like we do, that actually can tell me where you are financially, tell me where you're going, tell me what your plans are, because then I can tell you where you need to start and when you need to make that change. Sometimes people are so afraid of filing a tax return because they think, I'm filing late, the IRS is going to come after me, they're coming after my home. I actually had somebody come in to my office with that fear. They had so much fear that the letter from the IRS, they had it in their hand. They hadn't opened it yet, right? So they give me the letter and they say, I'm just afraid I'm going to lose my house, I'm going to lose everything. And I said, what happened? She said, I missed the last tax filing date and now I'm really scared. So I said, can I open this letter for you? So I did. I opened the letter and I said, can I read it to you now? And she said, sure. And she was holding her breath and just almost in tears actually at that point because she thought she was going to hear something from the IRS that said, you're dead, we're coming after you. Well, you know what the letter said? It said, dear taxpayer, we've noticed that you haven't filed your tax return for last year. Could you please send it to us? Literally, that is almost verbatim what the letter said from the IRS. So there's really no need to be afraid of the IRS when it comes to not filing. That fear of that huge tax bill causes some people to actually not file their tax returns, and that's really a big mistake. Here's why. When you file that tax return, what happens is that the clock on penalties stops when you file that return. Yeah, they're going to charge you interest for not paying the tax that you owe, but the penalty stops when you actually file that return. So you want to file that return so that you don't get late filing penalties. However, now it comes the issue of, I owe a lot of money, how am I going to pay it? Well, the IRS actually allows you a whole bunch of different ways to pay it. One of them is an installment agreement. An installment agreement it's written into the code, so it's not like they don't have a choice, they have to give you an installment agreement. It's an agreement to pay off the debt over 6 years at really the lowest interest rate that you can possibly find, even on a credit card. Even your lowest credit card probably doesn't have as low interest rate as probably the IRS does. But it allows you to pay it over 6 years. A vast majority of people use their neighbor as their tax preparer. In other words, their neighbor will say, I took this deduction, or my accountant said I could take this deduction and therefore I took it. You might be able to take that deduction, but that was your neighbor, not you. So when you've heard the topic, or no, you've heard the topic, you've actually heard the line from tax preparers, maybe when they say, you ask the question, hey, is this deductible? And the answer usually is, well, it depends. It depends on a lot of things. It depends on what that expense was for. It depends on the entity that you are. It depends on who owns that asset. There are so many things that depend on whether that's deductible or not. And if you're going by what your neighbor said, chances are you might be wrong. Hawkins Martinez. We're an enrolled agent company. Now, what's an enrolled agent? Well, an enrolled agent is someone who has a license from the federal government to represent you before the IRS. What does that mean to you? Well, besides the right to represent you, it also means that we are regulated by the IRS. Regulated means two things. Number one, the term enrolled agent tells you what we are, agent. We're not an agent of the IRS, we're your agent. We're actually, like attorneys, designed to protect you, protect your interests. So if you did something wrong on your tax return and I call the IRS and say, oh, this person did something wrong, I lose my license because I'm not the IRS's agent, I'm your agent. The other term is enrolled. Enrolled simply means that the IRS is the one that's keeping an eye on making sure that we're doing our job right of taking care of your business. Part of that requires that I, as the enrolled agent, every single year actually get more education on the changing tax law so that I know exactly what I'm doing when I'm actually doing your tax return. Now, other people, by the way, can do your tax return. They can charge you for it. But if they're not enrolled agents, if they're not CPAs, or if they're not attorneys, and they're not required to actually keep that education, they can still do your return, they can still charge you for it, but they're probably not going to be able to back you up.